Hey everyone, this is Ed McGill, co-founder and partner of McGill Jungie Wealth Management. And back by popular demand is our Director of Investments, Jason Kirchhoff, for our latest quarterly market commentary. How you doing, Jason?
Good, Ed. How are you?
Doing great. And we're doing this today where we'll be looking at 2025, which was definitely an interesting year in the markets, a lot of positivity. But we're going to talk about process versus outcome, some of the decision making we made towards the end of 2024 that was implemented into our clients' portfolios, and then how we're looking at things going forward. But Jason, before we kind of go through some more of the deep dive, you referenced a great book, and you will be in the written version of the quarterly commentary. Why don't you talk about the book?
Yeah, it might seem like an odd book when we're talking about investments, but it's a book called Thinking in Bets by Annie Duke. And Annie's a former professional poker player. Now, she does have a pretty good education in psychology as well, but the book is all about making decisions and what's the best way to make decisions, and then what's the best way to judge the outcome of those decisions. What's interesting is when there's randomness involved, you can't just look at the outcome. And she calls it, I think the term she uses is resulting, that oftentimes we'll just look at the results and say, well, that was a good decision or that was a bad decision. Do you remember and this is an example she gave in the book, do you remember the Super Bowl between the Seahawks and the Patriots?
Yes.
It was like 2015. And there was that decision where they decided to pass it on third down rather than just run it from the 1 yard line.
When they had Marshawn Lynch. Yes.
Exactly. And everybody was saying, oh, that was a horrible decision, right? Should have just run it. And obviously a lot of that judging was based on that bad outcome.
Yep.
But what's interesting, that was back in 2015. What you've seen now using the NFL as a further example of this is it is more about probabilities and the analytics behind these decisions. And no longer is it, well, you went for it on fourth down and you didn't make it. That was a bad decision. It was, well, here are the probabilities. Here was where you were on the field. So there's been some advancement and evolution in not just judging decisions by results.
When you were talking about Annie Duke, I'm picturing when you're at the blackjack table, primarily at the lower dollar amounts, and like someone does something that you know is against what should be happening. They split something, they double down, they don't take they take a card when they're at 14 and the dealer's at 16. And you're like, oh, you're just thinking, you can see people grimace on there, and then they may win, and them and their buddies are high-fiving, and you're like, that was just luck, is maybe something tied to what she was writing about.
Yeah, I joke with my kids a lot. This is probably a hyperbolic example, but I always tell them, if you win the lottery, I would still argue that wasn't necessarily a good decision to buy the ticket. Now, that's whatever. That's a little out there, but it's that same point that you can't just look at the outcome and say, well, that was a good decision or that was a bad decision.
No, that's interesting. And before we get into just the thought process and the rationale here, I also think back to, I'm older. So, the tech crisis, back in 2001, where prior to that, you had articles being written by people that were taking their 401k, the rollover IRA and going 100% into one single company stock. And I remember seeing, it was Money Magazine was always on the shelf at the grocery store, and how this barber or this doctor or someone did that, and, is getting this article written about them. And, at that specific moment in time was a decent or good outcome without really a process or thought into it that inevitably probably hurt them if they didn't make any adjustments after that. So that's kind of another example just tied right to the markets.
It's a great example. And I think good luck can be one of the worst things that can happen to investors. Like when I was young and it was early during the tech bubble and was, getting lucky on options or stocks. And all of a sudden I think I'm a genius when there was really no process behind it. So good luck can be pretty detrimental to people.
Well, and that's the chart that's in the commentary where, you can have a good outcome and a bad process, and she just calls that dumb luck, on that versus a good outcome and good process. is deserved success, skill, plus luck. She mentions bad outcome, which is bad and good process, where the process was correct, everything should have worked, but was just some bad luck. Could have been timing with a new administration. Think of the tariffs. Think about tax law changes and things like that. Could have just been wrong time, wrong place. And then she also talked about, I like this one, bad process and bad outcome. She called deserved failure. And so these 4 quadrants where people can fall into. And I think that was interesting, and maybe kind of part of the her book that was interesting for you to read. Is that correct?
That's right. That's right. And it's how we think about in the investment committee, looking back at our decisions, and we write up rationale for why we made a change in any portfolio. And then we want to go back and look at that rationale rather than just looking at the outcome. Sometimes good luck happens, sometimes bad luck happens. But what was the rationale? And has anything structurally changed that would cause us to say, okay, it's time to move on? Or in some cases, the conviction level can go up.
Yeah, and that's great. So maybe tell people a little bit about the investment committee, how often they're meeting, who's on there before we get to this process, and then some of the decisions that were made at the end of 2024.
Yeah, so the investment committee meets monthly. We don't make decisions every month. In fact, it is more about an open conversation and some of the due diligence we're working on. But a lot of our research doesn't result in making a decision, because we think the conviction level needed to make a change is pretty high. A lot of that is taxes, right? Because that's a known cost. If you're making a change to a portfolio, it's likely you're going to be pulling forward taxes. So we meet monthly. It's a group of 7 of us within the firm. There's a lot of experience on that committee, it's a good open discussion, and there's definitely no necessarily set agenda every time.
So for those of you that are listening, you have Jason, that in the investment world, the CFA is the highest level investment designation you can have. 3 very incredibly hard tests over typically, 3 years if you pass them, each section. So Ross, Jason, Scott, and now Burke has started going down the CFA route. And then the KAYA, which is a Chartered Alternative Investment Analyst, is designations that our firm has. And Carson and Justin are partway through that as well, but those same individuals do have that. And so you have a very, when you said highly experienced, everyone there, except for me, has maybe managed institutional money or been involved with operations on the institutional side, et cetera. So, just a great group. And I'm there just to make sure that I understand what we're doing at a high level for our clients and the direction that the firm is going here. But maybe there was kind of 3 good decisions. When I say good decisions to evaluate now in hindsight, that were made. So why don't we go through those 3, and I think that'll be interesting for our listeners.
Yeah, we chose these 3 just because they were kind of the larger asset allocation decisions. So we've made other changes within the portfolio from a manager exposure, but this was more about large asset allocation exposures that we wanted or didn't want in the portfolio. Yep. So the first one we highlighted was trend following managers. And going back through the rationale on why we made this change, this was back in 2023. And this was, the traditional stock bond portfolio. Bonds weren't necessarily being that buffer that they were historically. And going back 30 plus years, there's been a slight negative correlation. We were concerned that we didn't have enough diversification within the portfolio. And a lot of that could be due to the debt situation, just bonds behaving a little differently than the trend we've seen. So we wanted to add something that provided diversification beyond just simple stocks and bonds.
Yeah, and when you look at that on the outcome of adding the managed futures, the trend following, 2025, how would you just kind of, overall in the portfolio, thoughts on that when we come into our next monthly meeting?
Yeah, if you look at trend followers in general, performance in 2025 was pretty muted. But what I would say is the rationale still holds. And I think a great example of this is the Fed started cutting rates in 2024, we actually saw the long end of the bonds, the rates go up, right? So that is a little different than what you normally expect. And I think it just highlights that relationship between stocks and bonds is still maybe the last 30 years was an outlier, and we're kind of going to go back to a little more positive correlation between those two. So thus the need for broader diversification.
And for those listening, when Jason said muted, there was a positive return from the managed futures, but compared to some of the other different asset classes was, you wouldn't look back on that in arrears and say that was significantly additive to the portfolio. And a lot of trend following strategies tend to do better when there's more market volatility or in down markets, which is where another for the rationale and why the conviction is there. Let's move to emerging markets. A great area last year, but ours has a little bit of a twist to it.
Yeah, we made the change to exclude Chinese equities, and this decision was a little different. It wasn't because we thought the future performance was going to be poor for those stocks necessarily. This was more about risk management. We have some concerns that capital markets in China aren't necessarily designed to just be efficient allocators of capital. There are other considerations, more national considerations. There's less transparency. They seem to sacrifice profit margin for market share. So there's a lot of concerns that there's a kind of a fat left tail risk of a downside with Chinese equities. And I think thinking through the rationale, that conviction still remains, especially as this trade war continues, and trade war historically can lead to capital wars, which would not necessarily be good for Chinese stocks.
Yeah, and basically the fund we use, which is ex-China, did about the same as just the emerging market index. So in some years it'll be additive, in some years it might be slightly lower. But I think also too, we had a lot of positive response from our clients that said from a risk standpoint that just makes us feel better. So then you get that added benefit. And then the last one, which we saved for last, just in terms of a pretty interesting success story where you talk about process and luck. Talk about the natural resources allocation.
Yeah, so this was another exposure that we added in the end of 2024, roughly the end of 2024. And the rationale behind it was this was a unloved, underinvested area that also provides pretty good diversification historically. It's one of these sectors that doesn't necessarily move with general economic cycles. It's uranium, it's platinum, it's gold, it's silver miners. There's some agriculture exposure typically, and I'm speaking just kind of general broad natural resource indices. So you have a lot of things that have been, as I mentioned, underinvested in. And thinking through the capital cycle, when the returns are really good, a bunch of money floods in, and then these companies go out and find new sources of these resources, and vice versa. And that's where we were. They had underinvested, hadn't been spending a lot of money looking for new resources. And I would say when we look at that rationale, I think our conviction has even increased, even with the strong performance, just because now we're seeing this deglobalization trend, the trend to kind of nationalize resources, where countries now are very careful about where their resources are coming from and want to make sure they have a good way to get them.
Well, awesome. Well, thanks for all of that, Jason. And, hopefully what everyone takes away from this is, one, the book is fun and some of the analogies and stories at the beginning. But here at McGill-Jungie Wealth Management, we do operate as fiduciaries. So to making sure that there is a rigorous process and thought going in before any changes are made. But then even after changes are made, that we are going to look back in arrears just to say, did we hit everything we were supposed to from the checklist of that due diligence and process? And then going forward, where's our conviction level? So appreciate you and your team, Jason. You guys do an awesome job. This is Ed McGill signing off for Jason on the latest market commentary for McGill-Jungie Wealth Management. Thanks, everyone, and have a great day.